Namaste and welcome for a session on redemption of preference shares under accounting of shares and debentures. A reference to section 55 of the Companies Act is essential in respect of redemption of preference shares. And it says redemption of preference shares could take place from two sources. One is out of profits. It may be in the form of general reserves and surplus, and that amount could be taken to pay out the preference shares who are redeemable. Or the company can make a fresh issue of shares, and from the proceeds of such fresh issue, the preference shares could be redeemed. These are the two sources. The second condition it says is a preference share can be redeemed only when it is fully paid. For example, if there are 1 lakh shares issued of redeemable preference shares, if 10,000 of the 1 lakh shares is partly paid, then even if the company has got the resources by way of free reserves or from a fresh equity, redemption can be done only to the extent of 90,000. The 10,000 which is having calls in arrears cannot be brought under the purview of section 55. Therefore it says redeemed only to the extent of fully paid shares. Then it once again says it could be redeemed out of profits of the company. Whenever the redemption is from the profits of the company, there is a requirement that whatever amount is taken out of the reserves and surplus for the sake of redemption, it has to be transferred from reserves account to a new account called Capital Redemption Reserve Account. Means Capital Redemption Reserve Account will replace the reserve and surplus account to the extent the reserve and surplus is used for redeeming the preference shares. Let us take a view of the process, and before that, not to forget, once you transfer the proceeds to Capital Redemption Reserves account, that could be used by the company at a later date for the issue of fully paid bonus shares to be issued to the equity shareholders of the company. Same thing diagrammatically if we put it, there is fully paid preference shares to be redeemed, partly paid to be ignored, and it could be redeemed at a premium. Now the question comes is, how do you fund the preference shares face value and how do you fund the premium on redemption? Let us take it further. In respect of the face value of shares, the two sources are from free reserves or from fresh equity. When it is fresh equity issued for redemption of preference shares, what we say is preference shares redeemed less fresh equity used, balance is redemption by using free reserves of the company. Therefore, face value minus fresh equity issued is equal to the capital redemption reserve created by way of using the free reserves of the company. To take it the other way, total amount to be paid is preference shares face value and premium on redemption. If you issue fresh equity shares, we consider its value to the extent of face value. Face value minus face value of equity has to be funded by the free reserves, and that free reserves is transferred to Capital Redemption Reserve account. And how do you fund the premium? Premium is funded from free reserves account which includes share premium account. If there is a share premium included in free reserves, share premium could be used for mainly two purposes. One, for payment of redemption premium, or for issue of bonus shares. Now, this diagrammatic representation makes it very clear that in any solution that you do, ensure that take the face value of preference shares, deduct from it the fresh equity issued, and for the balance, match the figures with the free reserves of the company. Transfer that free reserve into capital redemption reserve, and to the extent of premium, find out if there is a share premium account, make use of it for the sake of payment of redemption. If there is no share premium, use the other free reserves for that purpose. And any amount which is used for the sake of premium on redemption need not be transferred to capital redemption reserve. And remember one thing, capital redemption reserve always talks of the face value of shares, and it doesn't deal with the premium. Premium is dealt with separately. And capital redemption reserve can be used for issue of fully paid bonus shares. Now we are getting into the illustration just to understand the key features of the illustration. It pertains to decision of the directors to redeem preference shares on 1st January 2019, and the company has got 14% preference shares of 100 each worth rupees 1 lakh. And it is being redeemed by issue of further equity shares of 4,000 equity shares of rupees 10, we presume, and also 50,000 worth debentures, means 90,000 is being raised by way of equity and debentures. And the debentures, the preference shares are being redeemed at a premium of 10%, means 1 lakh is the value, 10% premium means 1,10,000 is the payment required to be made. And to get the liquidity, the company wants, in addition to equity and debentures, it wants to borrow a bank loan, also considering enhancement of bank balance of the company from 10,000 to 15,000. And when it comes to free reserves, the problem indicates out of workmen's compensation fund, there is a liability of 4,000, but balance could be a free reserve. And in case of development rebate reserve, it talks the other way. It says use 10,000 out of development rebate reserve, leave the balance untouched. Now this is the overall scheme. Now let us get into details of the illustration. The illustration talks of 14% preference shares of 100 worth 1 lakh rupees. Under working note, we say 1 lakh rupees is decided to be redeemed by the board on 1st January 2019, and we note it 14% redeemable debentures redeemable preference shares 1 lakh rupees. Then redeem preference shares at a premium of 10%. That is the decision. Premium of 10%, it comes to 10,000 rupees. Therefore, the total amount to be paid comes to 1,10,000. As there are no calls in arrears and all shares are 100% paid up. And it says, for the sake of redemption, they are issuing 4,000 equity shares. Means funds raised for this purpose. Equity is 4,000 into 10 is 40,000 rupees. Then they have also issued 10% debentures worth 50,000 rupees. Means totally we have raised 90,000 rupees. Our outgo is 1,10,000. We have raised 90,000, and if we look into, we have a deficit of 1,10,000 minus 90, 20,000. The company says raise a bank loan to provide funds for redemption to the extent of deficit. We have a deficit of 20,000. We could have gone for a loan of 20,000, but they say provide for funds for redemption and to have rupees 15,000 as balance. What is the present balance of cash that you have? Current assets including bank balance of 10,000. Now what the problem indicates is, please borrow in such a way that your bank balance is raised from 10,000 to 5,000. Means we need money for two purposes. One, to redeem the debenture preference shares, and second, to increase the bank balance from 10 to 15,000, means we need another 5,000 extra. That 5,000, when we take it, our total borrowings will be 20 plus 5, 25,000, and loan will be raised to that extent. And that will be the preparation for redemption, arranging for the funds. This is only working arrangements. From here, we proceed further. This is where we get into finer details of our working. 14% preference shares of rupees 100 each. We will be taking it into working. And as per our module also, 1 lakh rupees is fully paid preference shares face value less fresh equity issued. And fresh equity issue is 4,000 equity shares. We take that 4,000 equity shares. We can also see it posted here. When we post that 40,000, 1 lakh minus 40,000 is nothing but 60,000, which is the value of capital redemption reserve. And that capital redemption reserve has to be procured from the free reserves. Now, once we derive the capital redemption reserve, we should find out from what source of free reserves we are going to get it. And that process is very simple, because we have got the list of the whole reserves available here. We need to identify 60,000 for capital redemption reserve, and for premium we have to identify 10,000. Let us take that. Securities premium account, what is given here is 10,000 rupees. This 10,000, and we have a share premium for redemption of preference shares is 10,000. That is matched. We take care of 10,000 redemption premium, and from the reserves we take 10,000 securities premium, and that will help us match the two as we see it here. Once the 10,000 is taken from the free reserves, we have got securities premium taken care of. What we need to take care of is only capital redemption reserve of 60,000. And when we see, there is investment allowance reserve, which is a income tax based reserve with restrictions for usage in a specific period. Though it is not applicable now, it is, we can consider for the sake of this example, it is not a free reserve, therefore we are not touching it. Then we have development rebate reserve, which is 20,000 rupees, but there is a guideline in the working note. Utilize 10,000 out of development rebate reserve for the purpose. Now they are not talking of what adjustment to make. They say we have got 20,000. Make use of 10,000 for the sake of capital redemption reserve. We post it here. 10,000 rupees out of 20. Then comes workman compensation. We have 10,000, which is a free reserve, but the problem states there is a liability against workman's compensation of 4,000. Out of 10,000, 4,000 is the liability. Balance 6,000 we can make use of for capital redemption reserve. Then comes dividend equalization. There is no liability against it. We can make use of it fully. 12,000. Now our requirement is 60. 16, 10, 6, 12, 28 is already covered. We need balance 32. our profit and loss account has got a balance of 38. We pick out 32 and then make it 60. Means we have transferred the amount to capital redemption reserve from free reserves to the extent of face value of preference shares redeemed less fresh equity of 40,000. That is 1 lakh minus 40,000, 60,000. That 60,000 is transferred from free reserves like this. With that, now we are coming to the last portion of it. What is the payment to be made on redemption? We have got 1 lakh worth to be redeemed, 14% preference shares. It has to be redeemed at a premium of 10%. As we know, we have to pay 10,000 rupees. Total payment to be made is 1,10,000. How many shares? 1,000 shares. But there is a small mention at the end. Necessary journal entries to be passed, presuming that holders of 100 shares could not be located. Means what? We will not be able to pay them now. Once they locate, we will pay. Till such time, it will continue as a liability, as payable to shareholders of preference shares since redeemed 100. For 1,000 shares, we require 1,10,000. For 100 not to be paid is 10% of it. 11,000 will be kept as a liability for non-traceable holder, and net payment that we are going to make will be 1,10,000 minus 11,000 equals 99,000. And this point has to be noted here. This is the basic working for the sake of passing necessary journal entries. From here we can proceed for payment of 99,000. Now we proceed with passing of journal entries sequentially. First we pass entries for collection of funds. We are issuing equity capital, we are issuing debentures, and we have taken a bank loan. Then we pass the basic entry for transferring the value of preference shares into the preference shareholders account. Let us start now. 4,000 equity shares of rupees 10 each. For collecting 40,000, we have received the amount, bank account to equity share capital account, 4,000 equity shares of rupees 10 each issued at par. Okay. Then we are going with issue of debentures, 10% debentures worth 50,000 rupees. We pass the entry, bank account to 10% debenture account, 50,000 rupees. Then we go to the bank loan that we took. We took 25,000, bank account to bank loan account, 25,000 being bank loan raised for funding the accommodation. Then all these monies are available. Now we have to start redemption process. How do we redeem? Take the face value of shares, 1 lakh, take the redemption premium and credit it to the owners of preference shares. Preference capital account 1 lakh, redemption premium account 10,000 and preference shareholders account 1,10,000. With that we have collected money. We have credited the amount into shareholders account pending final payment to be made. And this is the liability that is created, 1,10,000. And from here we will proceed with the balance 3 entries, starting with the securities premium, 10,000 rupees. Securities premium set off against redemption premium. The entry is we debit securities premium and credit redemption premium. And that will be entry number 5. Securities premium account, which is transferred from free reserves to cancel out the redemption premium that we are going to pay to the redemption preference shareholders. After that, We have to transfer from free reserves 60,000 rupees item by item. We have identified 10,000 from development rebate reserve, 6,000 from workmen's compensation fund, 12,000 from dividend equalization reserve, and the balance 32,000 from profit and loss account. And as a matter of requirement, we need to transfer this amount to capital redemption reserve account. As we saw, it is the difference between fully paid preference shares face value and the amount of equity that we raised. The balance has to come from free reserves. This entry takes care of that. Then the last entry is for payment of money to 1000 minus 100 shares, that is 900 shares at the rate of 100 plus 10%. We will be paying 99,000 rupees to preference shareholders. Balance will continue in the balance sheet as a liability as payable to the claimants as and when they are located. With that, the whole transaction as envisaged in this model also is taken care of. What we have to understand is this credit capital redemption reserve could be used in future for issue of fully paid bonus shares. Hope you found the presentation useful. Thank you so much. Thanks a lot.